Thanks, Rich. Thanks so much. Appreciate the opportunity to be here. Again, Mark Nelson, Director of Commodities with the Kansas Farm Bureau. Basically, just like we always do, I'm going to kind of run through marketing plans and maybe some of the decisions we're trying to make now as we're implementing those plans. And so, this is something we've been doing for the last couple of years. And I guess one point about our winning the game marketing plans that I run through, these are essentially just outlines or maybe benchmarks, providing things for you to be considering, and more importantly, on that benchmark side, something for you to compare what you are doing and your actions and what are you doing. And like we've got right now, I think 30% of our wheat crop forward cash contracted, so we're delivering on that. We're in the middle of harvest right now in Kansas. At this point, I'm kind of wishing that we would have done more. But our plan, that's what we wanted to get done. If you're there and you haven't done any pricing and you've seen prices fall $1.50, maybe we should have been thinking about some of the things that we were talking about. I guess I don't want to get after people too much, but consider these plans that we run through a benchmark, something for you to target and do better than. So beat the old fart on the webinar. Again, to be effective, a marketing plan has got to include pricing increments. It's got to include pricing targets and date targets, and we try to include that in all of ours. So without further ado, let me move on to my next slide. This is sort of kind of where we stand in on our pre-harvest wheat marketing plan. This is probably the last time we'll run this slide. Back in May, we chose to let that uptrend continue. Right prior to that, we had forward cash contract 10% of expected production at 651 futures, which at that time was about a 608 forward cash contract here in Kansas. About 2 or 3 days after that webinar, we put in what you might call a key reversal. We traded higher that next Monday than the previous trading day. We also then closed below the lowest trade on that previous trading day. And I took that to be a signal that, hey, this thing might have just run out of gas. We priced the rest of that. We were at our $7 target for where we wanted to be at futures. And so we did the other 20%. Again, from a forward cash contracting standpoint, that we equated out to about a 670 forward cash contract. And if you notice then, between April and June, basis has tightened. And largely that means all prices have fallen a little bit, really, but futures have fallen more here as of late than what we're seeing in the cash prices. And so basis has tightened a bit. And so now we are done with our pre-harvest. We've got 30% of expected production priced at an average price of 684 futures, and that equates out to about a 649 forward cash contract. And again, if you kind of look around locally, I know in Salina, people are delivering now about 576. So I feel pretty good about that 30%. But now what do we do with the rest of this crop? And so let's take a look at our some of our opportunities. And this is a slide that we've shown a few times. This is a Salina-based example using on-farm storage. It's a comparison of our 2024 post-harvest wheat marketing alternatives. And as I go across there, A, B, C, and D, A is just sell the grain and be done here at harvest. I checked last Friday, cash price in Salina was 576. You could also sell that grain, this is BB, sell that grain and buy a call option. Go out there and get a broker, buy a call option. I looked at buying on at the money, so that'd be about a 620 at that time, because we'd be looking at March futures. March futures on that day were 617. So that March call that I'm buying at the money strike was 49 cents. I have that in as a negative because it's costing me. Another thing we could look at is what I call a spread, a bull call spread. So we're again buying that out of the money call, so the same as B, but then we're also in turn selling. So we're opening that account, we're selling, we got to put up some margin money, but we're selling a call option. And at that time, I was going 50 cents out. So I from my 620, so I bought I sold a 670, and that was going for 33 cents. Back last Friday. So that lowers my overall cost, and makes my minimum price a little bit better. Then the other thing to do is store. Now, I only like to look at, storing a storage hedge. And so, that means selling March futures. So selling at 617, our expected basis, say after about 5.5 months, say in about the middle of June or middle of January, excuse me, it is giving me, now it's all adding up to be about a 4-cent loss. And again, kind of going back over the last few months, as early as April, we were looking at a 30-cent gain if everything held. Obviously hasn't. What's happened? Basis has tightened and futures have fallen. And now, storage, at least the storage hedge, doesn't look as profitable. So we're kind of back there. The preferred thing to look at least from my eyes, is maybe this call spread. Again, haven't really pulled the trigger on that. And if we look a little closer at the math, right, trying to implement this call spread, our objective is to maximize our income relative to the harvest time wheat futures price, or the wheat price. A March call spread does a couple of things, right? It provides the opportunity to take advantage of any significant price rallies. And we're hoping that maybe as we go into fall, we'll see a price rally. And this call option would let me do that. What we're going to do is buy an at-the-money call, and then we're going to sell a 50-cent out of the money call. Now, I'm just choosing, and that's in blue there, I'm just choosing 50 cents. You could go $1 higher. But the trouble is you go higher, like at current prices, and let's just get down here a little closer. Look at that table I've got. 621, so that last Friday, March futures closed at 616 and a half. I said, let's buy a call option. If we look at that, 620 would be the at the money. It was costing 48 and a half cents. And then I went out 50 cents and said, well, let's take a look at a 670 call. Well, that, if I sold that, that would get me 32 and a half. If you went out farther, so say a $7 call, those were much less. And so it's, my minimum price would have been lower. My break-even futures wouldn't have been as good. And my gains, potential gains, would be better. But I felt like I like the idea that I'm getting more for that, and I'm keeping my minimum a little higher. So that's what I went with. I'm always looking at 50 cents. Now, the two things you'll look at, I looked at 618. March futures were 642. We lost about, almost 25 cents nearly in just 3 days or 4 days. But really that maximum gain stayed there in that 30-cent range. So once we pull the trigger on this thing, I'm probably going to stick with that, whatever the at-the-money call is that I'm selling, and then, buying, and then going out 50 cents to sell one that's 50 cents out. My target price, if we've got a maximum gain of 30 cents, I'm kind of saying, hey, if I can get 20 to 25 cents, I'm going to grab it and be done whenever that happens. Otherwise, January 31, we're going to get out of that position and close that. So that would be the plan, but I haven't implemented it yet. Again, we'll keep looking at this thing every day. As we look at the futures, and again, my gosh, we've lost $1.56, right, since May 28. And I want to review real quickly where we stand. We've got forward cash contracted 30% of expected production at an average futures price of 684, average forward cash contract 649. We're going to sell all the uncontracted bushels at harvest. So all the rest of my grain, my 2 cents is that we should be selling that. For our purposes, within winning the game, we're going to use the average July price that AMS USDA comes up with for the state of Kansas, and we'll find that out in a month or so. We're going to implement a call spread, but the question is where, what price level? And my hope is, you see that red line at the bottom, that's at about $6. We're being free falling. Hopefully, we'll see that maybe hold, and then prices kind of consolidate there at that point, and that's where our rally will start. So that might be the place that we would implement this if we get down as low as $6 futures. And so we think about that. I'd be buying a $6 strike March, right? This is the March futures here, and then going out 50 cents, and that's my area. And so essentially, I'm trying to get a gain from March futures rallying from 6 to 650. After that position that I'm talking about, this spread, would not have a gain. I wouldn't lose any money, but what I'm trying to do is just trying to grab about 20, 25 cents to add to my value that I get at harvest. I'm just trying to grab 20 cents. And so that's kind of where this plan is. That's what this strategy would do for me. So with that, I'm going to kind of roll over now and take a look at where we stand on our pre-harvest corn plan. Again, back May 14th, we forward contracted $4.91. That's under my target of $5, but I was getting kind of nervous that this rally was running out of steam. Turns out it was. So we're standing in there at 10% priced. That equates out to about a 460 forward cash contract. And, kind of going backwards, comparing that to my total cost of production, my actual estimated cost of production, that's 436. So I'm above it, but I didn't really hit my target. This doesn't look like a very good chart, right? I feel like this is a very negative thing at this point in time. Hopefully, we won't fall through there below 445. So I think the question then for the day is this: should we consider sales? And this is something that Dan and I had talked a while back. Should we be considering sales at less than full cost of production? Typically, our targets within the Winning the Game program have been at our total cost of production plus, adjusting for basis, and then a little bit of a cushion to give me that target futures price. And in this case, it's $5. Should we be considering that? Now, again, I've already done some, and I think, at least, we're at 10% priced. What if prices just continue to kind of move sideways and then they fall? So should we be considering sales at less than full cost of production, or at least, maybe to get us 30% priced? So let's take a look at how we look at prices. What I've got here are 2024 cost of production numbers. And I work with our KSU Farm Management Guides. You can go to that site, www.agmanager.info, and go look at farm budgets. Now, what I've got then, or what I do is I get a weighted average of dry land and irrigated, with a goal of trying to come up with for lack of a better word, Kansas cost of production. Now, it's based off of these budgets, and the budgets, Dan and Mr. Eibendal, and I think there's a few other folks that work on that. They do a great job. They've got them for Southwest, Northwest, North Central, all across the state. I grab a weighted average. We can argue about that, but the point is really the bottom line is, what are your costs, not my cost. But in their budgets, they have things like direct expenses, okay? And then they have fixed costs. Direct expenses would be seed, fertilizer, herbicides, everything it takes to grow that crop, fuel, repairs, crop insurance, interest, labor, hired and operator labor, all part of direct expenses. Fixed costs then would be depreciation and land costs. Now, if you own that land, it's basically a return on investment. What they use is cash rent. And so arguably, if I'm renting ground, that ought to be a direct cost. And so, how you create your budgets are going to be quite different. And that's irregardless, right? You need to do it however you want to do it. But here's the yields that are used in those budgets. Again, a weighted average, 61 bushels for wheat. Obviously, a lot of folks aren't getting that, but I know a lot of guys in South Central Kansas dry land that if they don't get 75 bushels, it's a disappointment. So, 61 is probably for the weight, irrigated dry land, east, west, across the state of Kansas, probably not a bad target. Corn, 159 bushels. Again, that includes a little bit of irrigated. Soybeans, 53. Direct cost per bushel at those yields, 384 for wheat, 277 for corn, 507 for soybeans. Again, we've always been using the total costs, 653, 436, and 946. We add that basis and a cushion to kind of bring us up to our targets that we've been talking about for most of this year. $7 for wheat off the July futures contract, $5 off the December corn contract, $11 off of the November soybean contract. But the question then is, should we be looking at maybe a lower price, right? Looking at more of our direct costs and not worry about, those fixed costs. Now, if we try to, maybe include our cash rent into that direct expense, right? Cash rent would increase our direct expenses to $356. If we go ahead and use that 64-cent basis / cushion, that would make it 421 futures instead of $5 futures. And so again, kind of going back to my table, okay, we're there. So if we would price now, or maybe if we could see some kind of a rally up into the 470, 475 area, I would say for a lot of folks, we would have confidence that we are covering our direct costs, maybe not our full. And so we need to kind of sit back and wait. There's going to be a lot of reports. Dan's going to go through all that. A lot of great information he's going to be sharing with us. But we've got some big, so I wouldn't say we should make that decision quickly. But if things turn out after the acres report, et cetera, that maybe, hey, things are starting to settle in here and we could be trending down, I think maybe we should be looking fairly aggressively at any opportunity at price, maybe even back in that 470 to 475 area. Again, there's a lot of things we need to see what Dan's outlook is. All right, last slide, I think here is our pre-harvest bean plan. Currently, we are priced up. We've got our first increment done, where 20% of expected production is priced at an average of 1182 futures. Our target was 11, so this is the one plan so far that's actually following our course that we'd like. We did that two ways, right? We did 10% on May 8th, and then we did the other 10% there June 11th. Again, always above our costs, and so that's why we have a weighted average price of 1182. Our next pricing target is to get 10% priced with a price target of 1425. Again, we're not going to hit that probably, right? Our date target, though, is September 15th. So we're going to let this thing go, see if we can see a rally, and price that other 10%. Hopefully, maybe in that 20% or 12% area, right? If we can get it back up to the $12 area, I think that would be a great opportunity to price. With that, I'm going to turn this thing over to Dan. I want to thank everyone for these opportunities to visit with y'all and be more than happy to talk more about these plans at the end of today's presentation. So I'm going to stop this share and move this thing over to Dan. Thanks so much.
Great job, Mark. I wanted to bring up, let's see here, the current forward contract prices in for these major crops in Kansas that we're talking about. Now, not at this point, we can in the future for sure talk about cotton, sunflowers, other crops. But for right now, we've been looking at corn, sorghum, soybeans, and hard red winter wheat, and have both the current cash prices and the forward contract prices. Although for depending on where you're at in Kansas right now, those are pretty much the same thing. So let's take a look at. So Mark, I want to put these up here and then get your comment on as a follow up to the discussion we had on forward contracting. Let's take a look at corn. So you'll see here these are by the way, Friday's closing prices. These are the very top prices in these different areas of the state that we try to follow. Colby, Salina, Topeka, Garden City, Hutchinson, Columbus. You can see in Colby, Northwest Kansas, North Central, Salina, East Central, Northeast, Topeka, Canada, the regional leader, Garden City, Southwest, Hutchinson, South Central, and Columbus and Southeast. Let's take a look at corn. So you can see strength in terms of new crop bids out in the demand center, arguably a major demand center in the state, Garden City, 15 overbid off these corn futures, 468. But then a lot of other prices, all pretty much in like the 423 to 443, 448 area. And Mark, you'd said before that the weighted average overall break-even cost of production was 436. Is that the number that you're using?
That is correct. So dryland irrigated all across the state, kind of a weighted average.
So given what you talked about, how do you view these prices?
Yeah, well, right now, on the corn harvest for fall, again, now yield, if you've got yield concerns, that's going to change things. But if we feel like, hey, we're going to hit our targets, these costs are right in there, right? At 436, kind of that average, we're meeting it for the most part, across the state. But we're just at it. So obviously, any 20, 30 cent little rally could give us an opportunity to price above our total cost of production. And even if we throw in, say I'm going to throw, I am cash renting, throw that up there, cost of production, again, on average, this weighted average is about 356. So again, these prices, while not outstanding, for a lot of folks, can help us to at least cover our cost. Probably the biggest concern on this thing is going to be, if I'm in an area where it's starting to get very, very dry, right?
Right.
Because all of a sudden, I go into this thinking, hey, I'm going to yield this. And, I've read the reports on the wheat, for example. A lot of folks are surprised. Some folks are even hitting their averages and above. but obviously there's a lot of folks that are not. And, you know, you start knocking down that yield from what you had in your budget, that cost per bushel goes way higher. But at some point, you know, and again, that kind of goes into how we end up with our outlook, and I'll be looking forward to hear you. You know, sometimes pricing at a small loss is better than pricing in at a larger loss, depending on where prices may go. And again, that's why I'm kind of looking forward to hearing to what you got to say.
So let's just throw the other ones up here then for sorghum, for soybeans, and then for wheat. And one thing that does stand out in just looking at the prices is the strength, the relative strength actually in the Hutchinson area for upfront cash bids. A pretty decent bid for wheat, basically out into for the next 30 to 45 days out there in the Salina. You do see some strength for Hutchinson, both in the spot cash market and in the new crop bid for soybeans, and even on the sorghum side. So good for the Hutchinson bunch. Well, of course, they've got you know, that's an export terminal location for us, and certainly a market leader. So when you look at the grain sorghum numbers, generally, I think we're a little bit lower. Our cost of production may be lower too on that. I'm just given the structure of seed costs and whatever, but really in just about the same area as for corn, except in the Garden City region, to where the corn forward contract bid positive 15 and 35 under for sorghum for the best bid that I'd seen. And then for soybeans, I'd noticed on your break-even costs that we really don't have a problem right now breaking over or covering direct cost. It's whether we're hitting the full cost, full economic cost targets for soybeans that we're looking at. What was your soybean number again for assumed cost?
Yeah, soybeans, the weighted average total was 979. But you know, like you touched on Hutch, the dryland budget, South Central Kansas, total cost per bushel is 817.
Yeah.
Under the irrigated South Central Kansas is 953. So,
Yeah.
you know, it's right now forward cash contract bids are more than covering that.
Well, you know, and that type of a relative cash price versus the estimated cost of production holds likely across the Corn Belt. And when we're going to talk about the Friday's acreage report, and we'll see how much impact that may have on farmers' decisions, particularly on some wet late planted corn in the northern states. We'll see. And then for wheat, again, you see the Hutchinson 10-cent over, and really not bad prices in either Salina or Topeka at 10 under. Then out to the west, certainly weaker prices, 40 and 50 under in the Colby and Garden City areas. In Columbus, about the same, again in that same range. So we certainly have our price leaders for the wheat market, and we're in harvest. Even if we had a situation where we had just moderately lower prices, we'd probably still see somewhat of a short-term oversupply situation. It's really only in those really short crop years where we get an inverted market, and a major inverted market, and see prices across the board sharply higher than futures, but not so much the case right now. Mark, any thoughts on these prices?
I say on the wheat prices?
Yeah.
I don't like them.
No, they're not good.
Basically, you know, we're not covering our full cost of production. But,
Right.
you know, I guess, and the booger of it all is this, you know, hey, we're in wheat harvest. So,
Yeah.
you know, we all should be pivoting, right? We're wrapping up, delivering on anything we had forward cash contracted, and we're making those decisions on what do we want to do now with the bushels I do have. And again, the thing I'm seeing, and I love your comments on that, but it looks like basis is tightening up.
Yeah,
And so when we look out there and say, hey, I want to do a storage hedge, again, that selling futures, and you know, my gains to storage potentially are going to be less. Now, if we'd see some just crazy, black swan event and we see prices rally $3, well, obviously you got it in the bin, you're going to be in pretty good shape. But the concern is, I just feel like we've seen basis strengthen to the point that's not going to help me if I do a storage hedge. And so, I think what we're trying to do is figure out how do I want to own this stuff post harvest with the least amount of risk.
I do want to get to wheat, and you mentioned the black swan event, and the black swan event in wheat would probably be associated with the Black Sea. So just an irony of the terminology. But let's move on. So much of what will happen in these markets will have to do with weather, and of course we're sitting here at the end of June, July, August, right in front of us. USDA reports on production not starting until actually the August crop production report, and even that one won't have the USDA out in the fields doing their enumerated surveys. That will start in September. So we're right in the time frame when crop production uncertainty, if it's going to impact the markets for spring planted crops, this would be it. So let's take a look. We've had within the last, over the weekend, major rain, flooding up in Iowa, southern Minnesota, over into South Dakota, parts of Nebraska being affected, and you can see this is a soil moisture chart that has come into play, and so that moisture is coming into situations where this was on June the 17th, they were already wet, and so you've got some impact. You can see that for this chart, it's more the short-term moisture situation. This is the long-term composite situation. So some of these places that were pretty moist on the topsoil, still underlying had a long-term drought and deficit. So they're relying on rainfall to come. And then you got this here. This is from this morning, pulled this off of DTN. Chris Clayton, DTN Ag Policy Director, had this article up, so I certainly want to give them credit. I'm a subscriber to them, so if they have any question about that. But best information that I could see out there, 3-day rainfall estimates ending on that would have been, that would have been on Saturday. You can see major rainfall. You can see with my cursor here, the northeast part of Iowa, southern Minnesota, over into here, and again South Dakota, some rainfall. You can see the scale here. So really, these areas here, the red and such, they're getting 8 to 10, 6 to 8 to 10 or more inches extra rainfall. Down in here it shows blue, but that's a ½ inch to a ¼ inch, not so much. Although, talking with some people in the media in the Columbus, Nebraska area, they had some localized rainfall along the same line. So you have this, and so this comes at a time when the spring planted crops, and what would be out there? Well, you'd have corn, you'd have soybeans in particular in these areas. If there's local flooding, you get to the place where you have to ask the question, does rain always make grain? Well, it does until it doesn't, until you've caused damage. So that'll be a question that we'll be looking at. And the acreage survey that came out represented around September 1st. So all this has happened since that time. So it wouldn't affect the planted acreage, but it would affect, certainly, where there's damage, the harvested acreage. And of course, it's too late to replant corn right now. Possibility of perhaps some late soybeans, but we'll see. So here you have the calculated soil moisture ranking, just verifying again the wetness up here. But note over here the dryness in Ohio, Indiana, parts of Illinois, not so much now. Right now, up in Iowa, over here in Missouri, again Kentucky, etc. But and some of our state coming into play, and you do have the situation that I think is uh, on the horizon. And here on Friday's closes, we had 453 D's corn futures, 1120 November soybean futures, and the projections that, as you can read down here, La Nina is favored to develop during July, September, 65% chance, and that's up about 5% from where it was. And this is the latest advisory that had come out, and projected to get worse. At more of a La Nina situation out into November, January. So, and we associate that with pretty dry conditions. In fact, a La Nina to a short El Nino and then back to La Nina again is associated historically with some of the worst weather years in the Corn Belt that we've seen. So we've got that thing hanging out there. And I understand the market says, well, it's not here yet. We've got rainfall. We'll price it when we see it. But yet you have credible forecasters talking about this. There's a drought tendency monitor map that had come out, and you can see here drought development likely. So they're projecting the likelihood of drought developing over here in part of Iowa, but again, major swaths of Illinois, Indiana, Ohio, and of course that doesn't do us any favors either here in Kansas. So we're just because there's a broad drought projected doesn't mean that there'll be nothing in terms of storms coming through. And I heard a climatologist for an ag meteorology concern talking about, yes, temperatures projected to be high, but there'll still be moisture coming through in spotty manner. So you can see here again, this is projection till the end of July. Really, there's the wet area to the north projecting pretty dry through all the 3I states, and then on out to September. Really, from July to August, September, that the idea that, yeah, we start dry in July, but not a lot of relief projected to the end. So this is the mindset, the perspective of a La Nina coming in and impacting the Corn Belt this summer. I guess I don't want to be just a weather a negative person in terms of looking at moisture and crop production prospects, but this is out there, and this impacts, colors some of my own thoughts on terms of where corn markets are going, so corn and soybean markets are going, frankly, this summer, and the risks we have in front of us. I would just say quickly that you can see the down here in Mexico, again, the redder this is, the less moisture they have in this is a soil moisture projection, as I understand it. Mexico is really tight. You can see some not tight, but dry, and they've had pretty strong imports from the United States, and we've gladly provided that to them. So there's that in play. I should note also, if anything, they're too cool and too wet. Our good former K-State person that handled grain marketing, Bill Tierney, sending out information earlier today talking about how the problem in Canada north of the border is not dryness, it's lack of heat units. They're cold. So not normal weather patterns, but you can see the things we've been talking about really all the way through for about the last 90 days, that the situation in South America, and note down here, pretty wet situation in the South, Rio Grande del Sul, and other generally dryish areas. And I guess I would just say that these issues of what will come out for final numbers between in Brazil in particular, somewhat in Argentina, but Brazil in particular, still up in the air. The market is hanging its hat on the USDA numbers. You still have these other projections coming into play with all the moisture they've had, and in some areas and such. I guess the most polite way as an economist I can say that that issue will be resolved is that somehow they'll converge. There'll have to be a convergence one way or the other as to whether the in-country numbers are right or the USDA projections are correct. We shall see. But I would say, though, if we're tight enough for some of these commodities that if you continue to shave another 2 or 3 million metric tons off of Brazil, which is our major ag competitor, then that goes straight to world ending stocks, tightens that up even more, and eventually makes it tougher for people for countries to buy from Brazil just because of lack of quantity, and especially in the latter part of their marketing years when if they get caught short and it's just not there, then that comes back to the United States. So something to watch. It's a fair question to ask, when is that? Note up in here also, it's pretty serious concerns now in the wheat market that in Russia and Ukraine, they had dry conditions, had a late frost or two. Russia's come out and made statements that, well, I've got a headline from this morning. Argus slashes 2024 Russian wheat crop forecast on weather damage. So Russia has been leading a price, will be polite, a price leader in the wheat market. Basically, they've had a bunch of wheat to sell and they've sold it. They needed the cash. They're in a military conflict. So if they have less of that to push out, then eventually that impacts the world wheat market. And I really do think when someone looks at the United States to take advantage of that, you have this currency barrier to entry. Whatever happens in the United States, somebody's got to go buy the US dollar and transport it across the ocean. So you got a currency and a logistics disadvantage. There has to be enough of a shortfall all around the world for buyers to look at every place else they can buy. And oh yes, by the way, we'll come to the United States with their currency issues and whatever else, and then we'll buy. So it's been said before, we're sort of the buyer of last economic resort. We're just pretty expensive to buy from, and it is as it is when you start looking at Middle East. Forecasts of crop production problems. I have a hard time. I hear severe drought delays corn planting in the eastern China, and I see a little bit of dryness there, but I see the headline as well. So we'll see what happens out of that, and of course the ups and downs, variability in of what you see across Australia. I just would say here's just another map. This out of NASA, a group called NASA Grace. It's more of a satellite approach to looking at all these things, and just note it shows more dryness for sure in the Black Sea region, and does highlight the situation more so down in Rio Grande del Sul, parts of Argentina, and more of a drought effect in the western U.S. and highlights again the situation in Mexico. So something to watch. Friday is a potentially volatile day. In the grain markets, we have both the USDA acreage report and the grain stocks report coming out. And I think the acreage report will be the main one looked at. And again, comes out at the end of June. They did the surveys the first part of June. They were already having some planting issues in these same northern states that have now been exacerbated. So arguably, let's say those acres got planted. It won't be so much planted acres. It'll be more harvested acres at the end of the day for some of this. But you can see what's the plantings last year in the U.S. for corn, 94.6 million acres projected in March, and the projected plantings at 90, and a little bit of an increase projected for that. And like I say, that even if the planted acres increased, it's not the planted acres right now so much. That's the swing issue. It's more the harvested acres in those northern states. Soybeans, again, 83.6. Last year we projected 86.5. If anything, coming into the trade, they're expecting even higher soybean planted acres. And for wheat, the final plantings last year were projected to be down some, a little bit of an increase. And you can see for about the same, little higher for winter wheat. But again, that's for us, that game's pretty well over. The impact of that number. Other spring wheat, that's still in play, projected to be a little bit higher. Durum wheat actually projected to be a little bit lower. So some of the excessive wetness and coldness up to the north, you can see that coming into play, especially on durum wheat. And I just wanted to show you this quickly. So the 90 million acres, if planted for corn, it's in the ballpark of where we've been, and again about 91.2% are planted to harvested last year. So you get a perspective on where that acreage numbers is for soybeans. We're at 86.5 in the prospective plantings number. We have been higher than that in the past. And Mark's cost of production estimates based on the KSU numbers are certainly relevant to this as well. Just a lower profitability hurdle to have to jump. Wheat acres, again, you can see ups and downs. Actually, 2023 was a high year of late, and then we're moving back down to the low side. And for sorghum, I in Kansas going to be watching pretty close to see what the sorghum number is. We have had really strong cash bids for sorghum based on really good exports, but then again, the forward contract bids weren't anything out of the ordinary. They were proceeding back to kind of a normal corn to soybean, corn to sorghum relationship. So I did that time of strong cash prices that we had for sorghum, particularly as in May when we were planting. Did that have any effect on corn versus sorghum out here in the western areas? By rights, traditionally we'd say, well, if it's drier, yeah, and you really looks if you're at moderate to low soil moisture, that might favor sorghum. The corn people come back and talk about drought tolerant varieties, so we'll argue back and forth on that. But the point is that I'll be watching the 6.395 million acres planted number to see if there's any change. And you can see wheat acres by class, and the hard red winter blue number kind of up and down here of late. And the stocks figures. So when we look at the stocks figures, the calculation behind this is to see how much usage we had, and we have had during it'd be the quarter. Let's see, it'd be that's right. Let's see, November, yeah, December, January, February quarter. So that'd be that last quarter, then March, April, May. Right, we'd be looking at the usage during the March, April, May quarter, and we'll see. And implicitly, you can kind of see here where we were on March 1st, and what the trade's estimating for that for the usage. So they'll be calculating this minus this, and we'll for corn and these other commodities, but especially for corn for feed use, and we'll be seeing if that's above or below expectations. So right now, these are the numbers to hang your hat on to see if what we get on at 11 o'clock Central Time on Friday is a bearish, bullish, or neutral number. Okay, well, we've got a few minutes, 15 minutes here. I'm going to hit the highest of high points for feed grains. Okay, there's no surprise to anybody involved in these markets just to see where we're at. It's useful to me to put this on a price chart to see that if the recent lows we've had have actually broken new ground, or if we're just trading within a range or at the bottom of a range. It looks like basically that 435 that we got to on Friday is about where we were back in late February. We did get lower down to 420 again. I guess I would not. It'll take a change, it'll require the attention of the market and a determined view that we have no risk to see futures move far below that 420. And to me, there's enough weather uncertainty out here. I would be surprised. Of course, this is upfront July. You've got so Dees corn was 453. I think it's 453 and a half on Friday. So we'll watch and see where all that goes. Again, I don't know. It looks to me like the futures are taking pretty much a NASS approach right now to their forecasts. And Mark and I had a discussion on this. NASS has had input into the process for the coming out of the ag outlook forum. That the first NASS number won't show up actually till that August report, but we're kind of going on longer term approaches and as such. But given the NASS numbers that we have and how that feeds into the balance sheet, 453 is kind of where we end up at. The USDA's projection for the next marketing year is $4.40 right now. So that to me, you're assuming normal crops. You're assuming normal crops, and with what we've seen from our weather colleagues, there's at least a question mark to add to that. Projections on the futures, I kind of go on a monthly basis, project out based on futures, and on this red line, you can see by the time you look at as a percent of the season average price, it's a little bit of seasonality from the September lows to April highs, etc. This is going out way into the 2025 marketing year. You're projecting about 468, and that'd be a little bit higher than USDA's projection. But again, just take note, seasonality wise, you come out of June, you're coming into the latter part of June, heading into July, and you get the wideness of this range just opens the door for consideration historically of risk in the market. And this will be the point of contention. Right now, with where we're at, you could argue, well, we've got moisture, 181 bushel. That might be it. 177.3 was a record high we got last year. So are we in great enough shape around the U.S. Corn Belt that we're looking at 181? If you say that right now, well, the uncertainty, yeah, it's certainly within the range, but gosh, we've got these emerging La Nina worries to think about. So I'm gonna move here quickly. Let's get down to the last part. Okay, so this is right now the USDA is projecting 181 bushel an acre, and I would say there's about a 40% chance that that's going to happen. And with that, so 14.2% stocks used with their balance sheet, $4.40, and this is for the marketing year starting September 1. The one that we're in, 465, 13.8%. Then my own thoughts are that for the old crop marketing year, yeah, really not going to be a lot that changes there. And if anything, low prices probably spur on usage for both exports and ethanol. And we had pretty strong export usage here in the last 1 or 2 weeks of reporting. So we'll see. But the bigger issue is out in here, and I don't want to be just a stick in the mud disagreeer, but to me, I don't know, with all this weather, with all these weather questions out there, that it isn't just as valid, if not more valid, to consider at least the previous record of the 177.3 bushels per acre, which would be a tie with last year. And with that, just making that change only, pardon me, takes it down from a 2.1 billion bushel carryout down to a 1.8, from 12.2% stocks to use down to 12, from 14.2 to 12. And you plug that, you look at that, where that takes you price wise, and that's something over $5. So I don't want to be an irrational ag economist and just give out information that's unfounded, but I think this is an issue that, and frankly, this is what I guess from the rest of June into July and August we'll spend our time answering. Do we tie the old record, or do we go for the new one? And we'll see. So here you go. Then, so you can see where we're at. And 440 is projected by the USDA right now, and if we don't get, and so there's about a 40% chance of that happening, and I'd say so 2 out of 5 for that, 3 out of 5 for something less, unless we'll just say 177.3, the old record, and that's something over 5. So Mark, the challenge of this, but call you back on this. So for corn, the challenge of this, if this happens, it'll happen in the next 60 to 90 days, largely. And do our marketing plans extend that long?
Yeah, I mean, if it's in the back of everybody's handout. We have the let's see here, the corn or the feed grain and soybean plans out there, but they do, for example, the September plan, or they both go past that. We're hitting dates. Obviously, we're not going to have pricing targets, but I mean, our date things kind of hit in there. And again, obviously, given what you're talking about, especially the risk that's out there, and maybe imminently, as we'll see acreage numbers come out here pretty quick, we'll start seeing some updated supply demand. Clearly, it's probably not a time for people to start making a lot of, I mean, like from my standpoint, I sure wouldn't want to make any pricing decisions here over the next week or so. I want to wait and see what this acreage report comes out. But Dan, I guess a quick question here. We talk about, hey, if we see a lower yield on corn, what we got here on the slide, and we see prices go up. I guess my question is, as we see a dollar rise in prices, is that going to also back off a little bit of the use?
Yeah,
because you're holding your demand the same, and I guess if we see just let's see the market start ripping up as opposed to ripping down like it's been doing, would that potentially cut some demand down, and then do we end up kind of lowering our use a little bit? When we compare, like, say, column C versus column D, could that kind of a change in yield, could that possibly decrease, maybe exports a little bit, or do they back off a little bit on ethanol? What are your thoughts on that, on the impacts of higher prices on demand?
Sir, now I would say that's a very valid point, but we're only going to 1.8 billion bushels and 12.2% stocks to use, and we've been way lower than that. In terms of let's see, right, 1.8, you're still up in these ranges here. You're not even down to where we were in those 3 years when we were at 9.2 and almost 10% stocks to use. So if we do start to impact things, then you'll have introduced fear into the market, and more of a buyer's market mentality. So that could certainly happen, but this is only 1.8 billion bushels, and generally 1.4, 1.3, 1.5 is what we're worried about, and this isn't even 10% stocks to use. So, but when you look at historically where this would take us price wise, from 4, it's $1 higher, but it's not a 6 and a 7 in front of it. So anyway, that's how I'd respond to that. This is only something moderately lower, and that's just down to the record yield we've ever had. So anyway, let's go on. And so so let's the world situation pretty tight, and you can see that we've been moving downward. We kind of got to a plateau about 10% stocks to use, etc. So we got about a few minutes. Let me head on to I do want to say something about sorghum. Sorghum keeps moving along with decent exports. It's kind of choppy, but we're in the upper part of the range of where we've been, and sorghum relies on exports at this point. So just the way it is, when the prices get low enough, it certainly competes for feed use and ethanol use and all of that, no problem. But at this point, largely driven by exports. Soybeans, I want to show you this chart real quick. So note again, so we've come down off these highs that we'd had of recently down to 1160, but just like corn, we traded back down to sort of where we were in February, March, April. So I guess where we stand right now is we're not looking at any major worries coming in the market. Of course, this is only the July contract, and I think again 1120 was where November futures are. Again, not a worried market. New crop bids. You can see this red line here, season average price of 1150, and I think the USDA is projecting 1120. So again, just as for corn, projecting a situation of no worries. Also, just as for corn, projecting a record high yield of 52 bushels an acre. But we have been here before, but so. And that's very, very possible with soybeans, etc. As you move through there, want to get down to here, you've got the current situation in terms of stocks to use. Go back one step. Oh, there we go. So you're looking at climbing of ending stocks from 6% 2 years ago to 8.2. Last year to 10.4, and prices correspondingly moving down lower, 14.2, 12.55, 11.20. So again, no surprise. And if we get sizable crops, no doubt, given the way the market normally functions, that's where we'd be at. And in this situation, I've got some different scenarios here. Basically, this is the USDA's current projection with 52 bushels an acre. They come over and given problems, etc., I'm more inclined to still go with a good yield of 50, but not the full 52, and have a couple of these scenarios where we end up with pretty sizable crops and prices excuse me. I need to back up. When you try to rush, you don't do things right. Okay, so this is the USDA projection. Let's start this again. 455 bushels an acre, ending stocks, 10.44% stocks to use, 11.2, 1120 price. Okay, and the futures are about 1150. But here, if you just adjust the yield down 2 bushels an acre, you've taken about 71 bushels off of that, 9% stocks to use, about a little over 12 for price. If you have, and that, Mark, is as like you're talking about, that's with some rationing. If you have this and no rationing down to that, then you're at 6.5% stocks to use. You add about $2 to the price, and if you start, if you have this 10% scenario is basically the one where we finally get to the end of the road to Brazil, and it looks like the USDA has to converge downward to the in-country CONAB number, and we end up and have to we get more opportunity to pick up the slack in terms of raw soybean and soybean meal exports. So you've increased crush and exports, and then you're down to that. So I think someone with clear-mindedness could look at that and say, oh yes, that it looks like that we're panicky and just throwing out numbers that bring higher prices. I'm not trying to do that, but I'm just stating that if you drop from 52 to 50 bushels per acre on these acreages that we have, and then look at what the ramifications are, either with rationing or having to pick up the slack from Brazil, you find yourself in some pretty high price scenarios. So I just wanted to that's my thought anyway. So, but out of this 70% chance, 40% chance USDA is right, 30% chance, so we have a little bit of a cutback. You're looking at 1120 to 1225. Out here, you got about 30% chance on the high side. And let's go to, I want to take a look at wheat. Finish up here. So, Mark, this is the chart that you were showing, and for the July contract. And yeah, we're at basically got this just under 750. Have given most of that back away. 581 close, and if anything, if you're looking for positives, you've fallen back down, but you haven't gotten back down to these lows. Without these problems overseas, you'd probably be back down to 545, 550, and a little bit of carry in the market. And I know we've talked about storage hedges and such. You can see the monthly carry here for wheat. July futures 581, 587, September 603 DEES. So not a lot of carry opportunities out into the September contract, but you do start to see 5 cents a bushel a month, 15 cents if you held it all the way through from here to here. So anyway, some carrying opportunities. And if you're willing to long-term carry, well, you look at all that, you might storage hedge anyway. It depends on your cost structure, if you're a grain elevator or in the farming side. And the projected price, USDA's projected was at $6 for a projection, jumped it up to $6.50. In the May report, probably go back to $6 by the time it's all said and done. The futures right now thinking more along the lines of 580. Okay, so see all that's all fine. So let's come down to this. So I see where, this is what the USDA's numbers are saying. 2 years ago, 30.4% stocks to use. Last year, 37.5. This year, projecting 39.4. And let's do a coin flip. Let's say they're about right. And prices have dropped. As stocks have gone up, prices have dropped. And so here's at least my thought on it. 50% chance USDA is right. But then you come out here, 10% chance that even what's projected for exports, even with problems overseas, that we get weaker again, and that affects things. And yeah, we go lower. So at 50% USDA is right, 10% that it could get worse. So 60%, there's 40% chance out there if you're holding, if either lower total yields because of probably spring wheat, what's happening to the north, or higher exports because of the world situation, leads you to tighter stocks to use, something basically above $7 for prices. So that's not an astoundingly high price situation, but in trying to think through the scenarios of where we could go in the market, I think you have to acknowledge that we could get worse from here, and that's this scenario, but still some there. So Mark, I heard your statement earlier where you'd said, I think I'd sell and just get rid of it. And in this case, I'm 60% in agreement with you. So any comments on that?
Well, no, I like I say, I'm with you a little bit, and I think the point though is how do I want to carry this crop?
Right.
And I guess when we say, hey, let's sell it, well, it doesn't preclude the idea, right? Of maybe re-owning with an option or doing some things, and playing that. But yeah, things do look pretty bearish. And that may be ultimately the decision for folks, is that, okay, let's just be done with it. And I'm going to move on to 2025 wheat, and I'm going to move on to focus on my corn and soybeans the rest of this year. But there is, the potential for people to take a look at some of these post-harvest things, but maybe it's not by storing with the physical commodity.
somewhere out there, the tightness of the world wheat market will catch up with it. I make that statement. It became every month it comes out, we tighten it up even more. This in the June report, it got tightened down even more than it was. We're at a 17-year low, 18.5% stocks to use. This is a world less China. Again, the China numbers, we're unsure exactly what they are, and you've got this thing going on. But how do you tell people that are borrowing money that on this have money at risk, that and the market hasn't been responding to any of this, other than to know somewhere out there there has to be a situation where when buyers in the world wheat market go in and they can't find available supplies, there's just not enough there, and we keep tightening this thing up to where eventually you're there. So anyway, it's not here yet, and we've just had harvest, but somewhere out there it would seem that it's coming. I just don't know where. So with that, you've already passed. Rich, can we take questions for those that have stayed with us so far?
Yeah, we can do that. I'll open it up so they can unmute themselves. Folks, if you have a question, you can either put it in the chat or you can unmute now and just talk to Dan and Mark.
Hey, Dan, I've got one for you, though.
Yeah.
You just got done talking there a little bit about this whole concept of that world wheat situation, and really maybe it kind of goes with everything. Is tightening up. Do we have a shot that, okay, so maybe, yeah, we do kind of move on from the 2024 wheat crop, but do we want to be, as we start developing that plan for 2025, do we want to be a little bit more aggressive? Because it's like, hey, you know what, the risks of that big pop, that the world realizing that, you know, hey, there's not as much wheat and they're going to have to come to that market of last resort, the US, and that could really see a pop, and then we want to have a little bit of patience as we market and think about the 2025 crop.
I would think so. And how optimistic you are for those price goals for the next year's wheat? Well, I think it'll depend on how short in the Black Sea region they actually end up being. You've got some pretty dire forecasts of that, and the shorter they are, then the more worried the market will be all the way along that of whether they'll recover or not. And so yeah, that's certainly the case, I would say. And really, what we get in the next 60 to 90 days, 120 days will affect it'll affect ending stocks for this year, for corn, for soybeans, for grain sorghum, corn, soybeans especially, and beginning stocks for next year. And again, the fear of the markets about consecutive tougher conditions. So the impact of what we have going on now and what will happen in the next about 3 months will impact how we look at 25. That'd be my view.
Hey, Dan, there's a question from Ward Taylor. He says Friday's Kansas cattle on feed report showed numbers being down 6% year over year. That seems like quite a bit. Would you have any comments on what effect that may have on basis in Southwest and South Central? I know, and this is me, just monitoring and watching what the hay markets are doing. Man, all summer long, hay bids have just been dead in the water. So demand from feed yards has been very, very low. Dan, how do you feel like that's going to impact the grain and the corn and grain sorghum?
Well, I have heard it's more word of mouth, and I don't have the actual bids on this, but you hear of people that still have old crop corn being approached by people in feedlots in Nebraska or elsewhere that have a tremendous positive basis bid. So they probably have a situation where they are well, I'm stumbling around to say they didn't have enough supplies. They'd bought ahead, and so I see that. And also, Ward, you and I live in the same area. We drive on the interstate by the same feedlots, and when I see them empty, it makes me wonder what's going on. But I do see, at least from a limited sample that I regularly see, that there's some feedlots that are empty. So and I think that's more of a Glenn Tonser question as to the full economics of that. The last time I had looked, I think I'd seen negative returns on feeding, but again, we'd want to go on Ag Manager. I think Rich, you can probably point if you'd point that out. We're on Ag Manager. We find those feeding return numbers, but the last ones that I'd seen weren't very good. So on a monthly basis, so I guess I'd say, Ward, it's a response to lack of profitability. And what's surprising from a feed grain point of view is that with corn, especially being cheaper like this, it's not. It doesn't seem that's the corn side that's the weakness. It must be on the cattle side to where the margins aren't working. Thanks, Rich, for putting that up. I guess we'll see on Friday what these reports say. Ward, on that, that'll be the grain stocks number and that implicit calculation on feed use that's buried within that we'll be watching. Thanks, folks. May you all get rain in the next week or so. That would be a great thing.
All right. Thanks, Dan. Mark, thank you. Appreciate y'all being on. We'll do this again in July. I think it's July 22nd. So it'll be, Monday, the 22nd. So hope to have you then. And we'll have this video recording ready later this afternoon as well. And I'll send an email when that's ready to go. Thanks.